Welcome guys, my name is Gavin Pannu. This is a webinar brought to you by Alphachain Capital. So this is a trade floor talk webinar. We'll be covering some of the fundamentals, going some technical analysis, and then I'll be answering some of your questions. So let's get straight into it. Let me do a morning sort of brief, and then we'll go straight into some of the technical charts. Okay, so last week in the markets, we saw the US stock markets rise and it continued to sort of finish positive as the previous week did. So we're seeing this continuing sort of view in the markets of optimism. So we're seeing optimism still in the markets. And that's not optimism from the currency markets or from the commodity sector. Okay, so when we're looking at different asset classes, each asset class is viewed in different light. From last week, the focus was on the pandemic. Okay, coronavirus is what is leading the markets to move in certain directions, and we're starting to see optimism step in slowly. There's this well-known sort of market recovery that's expected, the V-shaped recovery or U-shaped recovery, even some suggesting a W-shaped recovery, whatever you want to call it. That's what the hopes are currently. That's what is. That's the current hopes at the moment. So I think the optimism was led by a number of things. The first thing I'll probably say is that in the US, they are starting to hint towards reopening businesses. So reopening businesses in the coming few weeks. That's the first sign. Okay. The second sign would have been in the US, where the sort of epicenter of the pandemic was in New York City. So the cases and deaths have begun to recede. Okay, so we're seeing sort of lower numbers coming through. So again, another sort of more positive rhetoric coming through. So what happened with the S&P 500? So let's bring up sort of the S&P 500 and let's sort of talk through the charts ahead of us. So let's go into that now. Okay, so I'm currently looking at the Dow Jones, and we can click on S&P 500. Both are highly correlated. Both assets are moving in the same direction. The only difference is one enlists the top 30 companies, the other enlists the top 500 companies. Okay, so generally, I like to view the S&P 500. That's the sort of it's the broadest because it covers the top 500 companies. It's also the benchmark used by many asset managers, portfolio managers, even private investors are looking to beat the return of the S&P 500 on an annualized basis. So you could see that as your benchmark index. Okay, so the market itself actually closed quite positive. We're seeing sort of a 5% rise from the prior week, and we're seeing this sort of continuation of this rise taking place from the beginning of April, end of March. So the 23rd, 24th of March is when we saw sort of the lows almost testing the 2,200 handle, and since then it's been rising, almost reaching 2,900. Okay, almost reaching 2,900. This is a key level resistance. As you can see, sort of you got this resistance prior and support. Okay, so that first initial sell-off was supported at 2,900, had retraced back up to 3,100, and then broke through and came back to retest thereafter. Okay, so this is a key level of support, now resistance. So just put in a horizontal line. Okay, so in this region here. Yep. I may want to sort of focus on the most recent price action, so taking it to these highs over here. Okay, there we go. So that's my key level of resistance in the current market price. Okay, so what other news came through? Something to also suggest is consumer discretionary was outperforming. Okay, that's your goods, right? So Johnson & Johnson, P&G, those types of goods were doing rather well in regards to sales and numbers. The healthcare sector is also going to outperform, as there's this rush to bring in a something that can recede sort of the strength of the coronavirus. Also a potential cure, a potential sort of something that could limit the ongoing effects of this. I still remember this the quote from Neil Kashkari. Okay, so Neil Kashkari, who's the head of the Minnesota Fed, the Federal Reserve there, in that state. He stated that we're going to see a continuation of outbreaks taking place, and then outbreak control. And the first pharmaceutical company that can bring in something that strengthens our immune system towards this will be the most effective way. Okay, so there's going to be no cure realistically. It's most likely that our immune system needs to get used to this, right? So there is that side of things. Okay. What else? Financials. So if you look at financial companies, as I mentioned, last week was the start of earnings season. We saw a number of sort of earning companies releasing their sort of earnings. It was mostly the banks. Okay, so the top 5 US banks, we're looking at JP Morgan, Goldman Sachs, and Bank of America, and so and so. Okay, they released their earnings. They weren't obviously going to be positive. Okay, and that's why that sector was underweight. Okay. And underperformed. Now, moving on, despite we've seen sort of a bullish close, in sort of the US markets, we come into closer price action. We've seen this break onto sort of the previous highs. It's broken sort of the previous high from the prior week. We've seen the bullish move over here. We're still at this resistance region over here. A little bit more selling pressure coming in, but it's too early to tell if this is going to have an impact. Okay. Now, where is the weakness coming from? We've got to look at both sides of the coin, okay? So don't just be optimistic. Your goal as an analyst is to review all market information. Whether it's optimistic or pessimistic, whatever the information may be, and then form your own decision. Once you form your own, I wouldn't say decision, theme. Once you form your own theme, then your goal is to wait for confirmation from price action. Price action is your leading indicator into taking your trades, okay? And then the fundamental analysis comes prior to that. That helps you form your trade ideas and so on. So, there are a couple of areas that I would probably look into. The first is, the first negative that came out last week on Thursday was the fact that there was 5.2 million new weekly US unemployment claims was reported. Okay, so that's another rise in unemployment figures. And then also, what's really sort of on, sort of brought to the forefront is if I stay on Indicom and I go to US oil. Have a look at this. So, if I just zoom out slightly, okay, let's maybe move to sort of a 4-hour time frame. Right, where is the oil market right now? Right, we've seen a huge drive lower, a larger sell-off coming into place in the oil market, and these are now 20-year lows. I'm not even sure if I've got enough historical data to go back as far as that. Okay, so we're looking at, early 2000s, right? Sort of not late 1999, 2000, sort of when we saw the last move over here. Okay, so do remember around this time is when we had sort of the last sort of dot-com bubble that took place. So yeah, I mean, these are the levels that we're at in regards to oil. Okay, and why is that the case? Guys? Why is that the case? Now, do remember, go back a week and a half ago. What took place in regards to sort of OPEC++, in regards to the Saudis mostly, but also in addition to this you had Russia and the US all come together and had suggested that OPEC+ group will go on to cut the amount of barrels that they will be producing on a daily basis, right? So that was predicted at 10 million barrels per day will be reduced. Okay. Now, that had a little bit of an effect in the markets, but it was shrugged very quickly because that's not the issue, right? The issue isn't on the supply side. The issue is more on the demand side. Okay, the issue is mostly on the demand side. So therefore, we saw price of oil fall further. Okay, now we're at levels, 20-year low levels, maybe more. We're currently sort of testing $13.77, and this could continue. Okay, this can continue to move lower. Now, this is going to drive a lot of oil companies out of business very quickly. Okay, there's going to be oil tankers out there that are just sitting and waiting on oil to recover in price. This is going to impact the Saudis, especially the US. Now, something that for you to look into, something I'll suggest for you guys to look into, is the fact that what is the break-in level for each country that produces oil? All the sort of, oil-producing countries out there, what is their break-even levels? Because everyone has a different break-even level, right? I mean, for the Saudis, their break-even level might be, say, $12 a barrel. Okay, and thereafter it could be a loss. So if this reaches below $12, they're in a loss-making position, right? In the US, it might be $18 a barrel, right? So you've got to view in light with who is this going to have the most impact on. But to be fair, the whole market will be impacted by this move, as we can see. Okay, so the demand side is the biggest issue. Okay, we're just seeing a slump in demand, and what's led to that? It's the coronavirus pandemic. Okay, so this pandemic has dealt a severe blow, especially to the oil market, as economic activity has just come to a standstill, and the demand for energy has been impacted the most. Okay, so the demand for energy has been impacted the most. Now, that's why we're seeing sort of in countries such as Spain who are looking to open up again, even though now there's a lot more talks in regards to them being uncertain about opening up. They're opening up construction quickly. Okay, they want to get back into construction where there will be a large use of oil. Okay. So yeah, the oil market's probably been the most trending topic or trending sort of view in the markets to take. What else has there been? Okay, now we're going to move over to currencies. Let's go into currencies. Let's start off with dollar index, and let's sort of hide some of this prior analysis. We're just doing a sort of quick overview of what's taking place, and we're looking at the daily time frame. We saw that rise, the breakthrough, the sort of 100 handle. Since then, it's been sort of just stalling. It's been stalling, almost converging within that handle. Okay, so around that handle, going down to the sort of 4-hour time frame. Now, something to mention here is the fact that when it comes to looking at the dollar index, there's two sides of the coin over here that you need to be considering as well. Okay, so even though we're seeing an optimistic view when it comes to the stock market and the way that investors and traders are diversifying their portfolio, and the hopes is growing in regards to the coronavirus will be short-lived. Okay, the pandemic will be quickly overridden and the markets will quickly come back up to sort of where it was previously. That's what the hopes is in the next coming 2 to 3 weeks, maybe longer, right? But the view is that it's not going to have an impact for the very long term. Now, the other side to this is that when you're looking at currencies, what's going to be the largest impact on currency? Because currency is not going to follow the stock market so much. There is that correlation. There's the inverse correlation to its market, but you're going to see the sort of uncertainty ahead of us as well. Okay, so overall, we've seen that the dollar index has been the one that's driving higher. It's the one that's growing strength, and it's continued to show strength all the way through versus all its other rivals, right? So when you're comparing sort of the euro, sterling, especially those commodity-based currencies as well, they're going to be hit the most, okay? So your commodity-based currencies are the Canadian dollar, Australian dollar, and Kiwi dollar to a degree, and then you've got sort of Norwegian and Swedish krona, but the dollar index is actually doing rather well, and it's purely being helped by its safe haven property. But not only that safe haven property is that in sort of, right now many asset classes has been driving in the same direction, but the fear of the pandemic, right, has led to one key outcome, is the fact that all investors and traders are looking for stability. When they're looking for stability, what is the safest thing that you could put your money into or have money in is cash. Everyone wants to hold cash. And the dollar, if cash is king, the dollar remains supreme. Okay, so the dollar is up there in regards to it being the world reserve currency. Okay, so that's why we're continuing to see strength in the dollar. But there are other issues as well when you're looking at, for example, cable. If we look at cable, okay, so we had a bit of a recovery in cable, but I'm still forecasting more of a downside. Couple of key points to mention now. The first being is that what took place sort of last week on Thursday, there was a continuation of a lockdown. Okay, so we had the previous 3 weeks lockdown taking place, and now we're extending it for another 3-week period. Okay, so there's another 3-week period of a lockdown taking place. But in addition to that, there's been over the weekend some scandals coming to light, reported across some major newspapers. Okay, and the main headline being is that the UK PM Johnson did not attend the first 5 Cobra emergency meetings on the coronavirus, and especially the concern is the fact that, one, the UK has probably the highest death rate in accordance to the number of cases taking place in the whole Eurozone. Okay, no one has a higher death rate percentage in the Eurozone compared to the UK. Okay, so that's the first sort of, a lot of fear coming through. But also, that death rate that we're seeing is not including any of the cases that are outside of a hospital. Okay, so these are sort of hospital numbers that we're seeing, and other numbers of, we've heard the numbers of deaths and cases that are coming across from nursing homes, care homes, and so on. It has been substantial as well. So there is a lot of fear that the UK is being hit the most in the Eurozone. And time will tell. Time will tell, what will take place. But there's been a lot more negative rhetoric coming from the political standpoint, and the measures that they've put into place, but also the uncertainty in regards to the percentage that we've seen in the death rate, right? I mean, it's close enough sometimes, in some cases we could see the numbers being enough to about 15% death rate taking place, okay? So, yes, there is a concern there. There is that concern there as well. Now, when you look at the euro, what are we seeing in the euro? So we're seeing a lot more selling pressure coming into the euro, as you can see over here. Now, why is that the case, guys? Why is that the case? And this is something that you need to bring to the forefront, okay? Now, do remember that this week we're going to see a resumption. We'll see the Brexit talks continue. We're going to see a continuation in Brexit talks. Sorry, guys, I'm not sure what happened there. We're going to see a continuation in Brexit talks coming through. But what I would probably say is that, look at sort of the different speeds that the sort of Eurozone is handling the coronavirus, okay? So we know in the UK, the lockdown measure has been extended for 3 weeks, okay? But in other countries in the Eurozone, they're dealing with it in different ways, right? So Germany are already allowing smaller stores to reopen. In France, they are going to be unveiling a new plan to lift these restrictions in the next coming 2 weeks. Italy still has an issue. It still has an issue. I mean, it still has a higher level of sort of cases, especially in Milan. So we're not sure what their plans are. They've not come across and defined any measures yet. In Spain, we initially thought that, okay, they're going back to normality. Not normality, but close enough when it comes to sort of certain industries. But again, those measures could be extended. Okay, those measures could be extended. So it's still uncertain times in regards to what is that sort of exit strategy for some of these Eurozone countries, and that will definitely impact the currency market. And we can see that the euro is going to be the one that's been mostly hit. Okay, remember that 54% of the volume that comes into the currency market is based on euro dollar. Okay, so euro dollar is the most traded asset and has the most amount of volume. So keep an eye out on what takes place in the euro. Guys, feel free to ask questions. This is also a time for you guys to ask questions as well. Okay, and so that wraps up. So that wraps up some of the key points I wanted to discuss in regards to the markets overall and what's taking place over the weekend. Now, there were a couple of key points to sort of mention also as we come towards the end of this webinar, and these were sort of something that were asked to me or asked within one of our sort of groups. Okay, and I'd like to sort of address these questions because I think these questions are great for everyone to understand as well. Okay, so I think the first question was that, okay, so, you know, someone's outlined that you should have a morning process, but also you should also consider the market structure across different assets you're trading. So the question being is the fact that when you're looking at the markets first thing in the morning, how do you define which way the markets are going to sort of move? What's going to be the driver of the market? Now, there's a couple of points that I want to make, right? There are three positions you can take sort of in the markets, okay? There are three positions you can take in the markets. One being is you could buy. The second is you can go short, you could sell. The third is you could sit on your hands, okay? You don't have to take a position. Not taking a position is taking a position, in my opinion, okay? You know, you not losing capital is you preserving capital. So remember, not always taking a trade and eager to take a trade is key. Okay, it is key, guys. So it's important that you remember that also, okay? Now, first thing in the mornings when you look at the markets, whatever the markets you might be looking at, for example, let's focus on, look at dollar yen. Let's look at dollar yen and let's drop it down to sort of a much lower time frame. We're looking at the 5-minute time frame over here, okay? Let me see if I can just bring up one of the key settings that session break. We'll put up a session break. We'll just make sure, yep, that's fine. Put that in there, okay. So we're looking at sort of the session. This is from last night, okay? So this is sort of, you know, the Sunday night open, which took place, we're looking at sort of 10 p.m. So we're looking at dollar yen, 10 p.m. Markets drove higher, okay? The strength of dollar outweighed the strength of the yen. So the yen, we saw weakness. The dollar, we saw a lot of strength coming through. It reaches sort of a peak level, the 107.90 handle. Comes back to retest there. Now, if you look at a slightly higher time frame now, right? So I'm looking at a 5-minute time frame. If I go on to a 10-minute time frame, what type of candle formation would that be? Just to highlight this, guys, what type of candlestick formation would that be? So if I just highlight that there, right? It's important you remember to start to put candlesticks together, okay? Start to sort of form what the higher time frame candlesticks looks like compared to the time frame that you're on right now, okay? Because that gives you a great indication of what what could take place going forward. You don't always need to switch to the higher time frame. You should just have that sort of insight already. There is actual terminology by the STA, the Society of Technical Analysts, which defines what this is known as. There's a specific terminology. Don't remember that terminology. Again, certain things you don't really need to sort of be aware of. But this is you merging the candles into sort of one candle from the higher time frame, and it builds a better picture in your mindset. Okay, so we've seen prices. Am I on the correct pen? Yep, cool. Alright, so we've seen sort of this being the market open. Market open leads to a bullish drive. We've seen a strong bullish drive taking place. A lot of dollar strength coming through, okay? You can see a series of higher highs and higher lows. Another higher high, higher low, another higher high. Okay, all the way through from this low up to that high. How much of a pullback do we see? Very light shallow sort of pullback, okay? Very light sort of pullback all the way through until it reaches the 107.90 handle, where we start to see larger pullback taking place. In fact, this pullback almost came back to test the previous low. So it hasn't broken the previous high, and it hasn't broken the previous low. It's still within a bull trend. We're still in a bull trend, but it's done a larger correction, almost a 100% correction back to the previous low, okay? You know, so that's your first indication that the market's strength to sort of drive higher is starting to slow down. It's starting to slow down now. And what takes place from this point of view, so that can be seen as a key level of support. Now, if I just remove the pen, just give me a second. So this can be seen as a key level of support. And we've got this as resistance now, okay? Come back to my pen. So that drives a little bit lower. Again, a little bit, you know, buyers stepping in it in this region here. So we had buyers stepping in here, now buyers stepping in over here. Comes up to this point over here. Doesn't really get back to the previous level of resistance. Doesn't really get back to sort of the previous level of selling pressure coming into place. Starts to sell a little bit lower there. Okay, so that shows that the sellers are eager to get into the market and really short this and drive this lower. Now there's a battle going on here now, okay, and price is now consolidating between sort of a previous level of high and a previous level of low, and there's a consolidation between those buyers and sellers. The strength of those bulls and bears is almost matched equally, okay. So again, this sort of drives a little bit lower, pulls back slightly, a little bit lower. Look at the candlestick formations, right? So it's either doing a large candlestick formation like this, like almost a Marabuzu style, or very small candlestick formations, okay? When you see that, there's a lot of uncertainty still ahead, and it hasn't gone into sort of, you know, define the direction. Now, the direction is not going to step in because until new information comes in, or it gets to an extreme level. That's the question, okay? So we're looking for either new information to step in before it either goes long or it goes short, right? Sort of from this consolidation region, or we're waiting for it to reach an unrealistic region, okay? So an overbought or oversold region before a flood of orders step in, okay? And in this case, we saw a breakout. So this being your initial breakout taking place here. So we had that breakout coming through. You can see how it comes up to this point over here. A little bit of rejection here, but then it has that instant breakout. Once you have that instant breakout, known as a false breakout, that's when the selling pressure really steps in, right? So there's a lot more sellers looking to sort of sell in at the 107.95 handle than there was the 107.90 handle. So that's a key level of resistance. That's your extreme. Okay, that's the extreme. You can almost see this as a zone if you wanted to on a slightly higher time frame, right? So that leads to that initial selling sort of, you know, view. And as I mentioned about this candlestick formation, right? So what happens? So it starts at this region here. It drives higher, right, up to sort of that point there. Apologies for sort of the line, should have been straight line, but hey. From this point, gets that high point, and it goes down all the way back to the low, and pretty much closes slightly above the open, even though it reaches sort of a low somewhere in this region over here, right? So in fact, this is sort of a doji, but a long-legged doji, sort of almost you can see that as what type of stone when it comes to a doji, but being a specific doji, what type of doji is that when you have a long wick to the upper side? Paolo, well done. Gravestone. Okay, that's a gravestone doji. Right, so that alone sort of leads the market to, you know, a flood of orders stepping in, and the strength of that selling pressure just comes in, right? So as this drives lower, it does the next pullback. So remember, why does a pullback take place? Why does that retest takes place right to the back to the resistance? Because this initial selling pressure here, it didn't really flourish. It didn't really gain that momentum. Okay, so what's taking place now is some of these you know, sellers over here taking a little bit of profit here. Okay, some of them are taking profit here. It drives a little bit higher, waiting for the next amount of sellers step in. That's another beautiful sort of candlestick formation on this time frame. Okay, on this time frame leads to the next selling pressure, and now we have that series of lower lows and lower highs now. Okay, so we've got the, you know, that's a low, lower high, another low, lower high, and that just continues, okay, until it gets to this point over here. We're in this zone over here with a larger correction taking place. Again, you should look to sell. You should only be looking to sell when you analyze the chart correctly. So you can see now we've gone through, right? So from the overnight, looking at dollar yen on a 5-minute time frame, how many types of structures have we gone through here? I mean, this question that was put into our group, you know, defining the market structure, this is how you should analyze market structure, right? We've got 3 phases here. We've got 3 phases over here, okay? You can, you know, we've got this phase here, this phase here. This is your bull trend. That's your accumulation stage, okay? So that's your accumulation stage, okay? Accumulation stage. This over here, this sort of, you know, in this region here, sorry, this is getting a bit messy here. This is your what is known as distribution stage, right? The market's starting to distribute in this region here. This is your distribution stage, okay? This here has got its own name as well. Exhaustion, right? That's an exhaustion move, okay? That's the sort of market becoming exhausted in this region here, right? And then we have that move lower. That's your downtrend. Okay, that's your downtrend. Okay, that's your sort of long-term downtrend. We're waiting to sort of get to a region. We're waiting to get to a region where we have a bit of consolidation, stagnation, and then we're waiting for the next accumulation stage to begin, right? So this is how you need to define market structure. Now, you as a trader need to determine this, right? When you're there at your desk, you wake up at, I don't know, 7 8 in the morning, you start your analysis. You know, every morning we do that 7:30 video conference call to define, you know, help you structure the day ahead. Okay, we talk about the most trendy news from overnight. We look at asset prices, round numbers. There's a number of sort of, you know, steps taken already for you to define the market structure. Now you need to determine what is that current market structure to take it to the next step. Hopefully that answers your question from that group. If you could just give me an indication if that makes sense. Guys, this is a time for you to also interact, ask your questions. Please do ask your questions. I'm just looking at if there's been any questions come through. The question is as follows: have you adapted your risk management to compensate increase indicators such as ATR? Absolutely. Okay, I like this question by Reese. Okay, so now you're talking about stop losses and you're talking about risk management. This brings me, so I can now take two questions. So there's a question that was asked to me last week on Friday, I believe, by one of our funded traders, and I'll take your question and merge them together. Okay, sort of discussing stop losses and risk management. Okay, especially in sort of times like this now, times like this. So to do that, let me just clear my screen first of all, and I do need to sort of bring up that question that was asked. Just give me a second. Right. Okay. Okay. Right. So one of the key sort of questions that was asked to me is, how do I determine a correct stop loss? How do I first of all determine a correct stop loss? And especially sort of in times like this, right, where over the last month we've seen an increase in volatility. Volatility has gained. Have a look at the volatility index. You should be able to sort of define that. Let's see if we go to currency. We go into the VIX. This is the volatility index. It's going to slightly drive higher, but if we go to sort of the 1 hour time frame, look at where the VIX it has been over the last since the beginning of March. Okay, since the beginning of March, this is what the VIX has done, right? It has gained. I mean, remember, what is the VIX? The volatility index is the volatility defined in the S&P 500. But to give it a very specific name and what it's known for, it's a gauge of fear, right? That's what it's gauging. It's gauging how much fear is there in the market, how much panic selling takes place. And if I can see, if I go to the sort of daily time frame, now we're looking at these numbers over here. If we sort of scroll back, you can sort of go, the last time we saw those numbers taking place was in sort of late 2008, early sort of 2009. Okay, and that was when the last recession took place, right? So we are in an extremely volatile period, and you need to now define how you trade. I have done a webinar on this previously, how you should be trading in this type of market. Now, if I come back to sort of the asset that I was looking at, okay, go back to sort of a 15-minute time frame, maybe a 5. Stick to sort of intraday view. Right. So just to highlight, the first thing I'll probably say is that in times like this, you need to increase the probability of your trades. In times like this, you need to increase the probability of your trades. And as I stated earlier, remember there's 3 types of positions you could take. You can go long, you can go short, but you can also sit on your hands. Okay, not taking a trade is probably a great time to do this now, right? All right. The last one is you get slipped or a gap takes place or whatever. You know, these are uncertain times to trade in, and you don't want to be hit and knocked out of position very quickly due to one, not setting realistic targets. 2, having too tight of stop losses. I'm starting to see that. A lot of guys, I've spoke to one of the traders from last week, and you know, he's up on his account. He's up on his funded account, but he lacked that confidence. He lacked that confidence, and one of the areas that we asked him to work on was the fact that set realistic targets and go on to review your ongoing trades and define, does market price, when you enter, go on to hit your stop directly? And if it does that, then you need to define thereafter. You need to watch that asset thereafter and see what happens. Does it hit the stop loss and then recovers and goes to your target? That means then your stop loss is too tight. You've got an incorrect stop loss. Or does it continue to go against you, which is now telling you that it's your trade idea? So you need to work on your strategy. You need to work on your entry, right? Reason for taking that trade. So it's about outweighing probability of the setup and the stop loss that you define. Okay. And then in times like this, it's key when you define a stop loss, okay, So I'm just going to go through sort of some of the things sort of I have written here. I'm just trying to look for those key points. This is it. Okay. Now, it's defining a stop loss and defining an in-trade management process is probably the most difficult part. I think if you're in your early days of trading, the first thing that you need to focus on is just defining a good stop loss and then defining a good target, a realistic target. Okay. Now your stop loss should always be your worst case scenario, which means that at what point you determine that trade idea is no longer valid is where your stop loss should be. If your stop loss is in a region where the market price starts to go against you and you have this fear and you quickly close that position, that means you're risking too much in the first place, right? So manage what your expectations are. Always have a stop loss defined at a point where it shows you that your trade idea was incorrect. And it should be allocated, and the monetary amount should be allocated to a point where it doesn't impact your pain threshold, right? Your personal sort of pain threshold, right? I remember we had a trader from sort of a previous company that I worked for who, did some training. He already had sort of the fundamentals in regards to trading. He really understood the fundamentals. He came to learn sort of more of the technical side of things. And when he left, he was working part of a hedge fund. The hedge fund gave him a large sum of money where, he was taking 0.2, 0.3% risk on his account, and that was a decent amount of money. He was taking £2,000 to £3,000 on a single trade, on the position, right? He wasn't used to that before that. He wasn't used to losing £2,000 to £3,000 on a single trade, right? So, he kept on taking a trade, and when it starts to go a little bit against him, he'll quickly close the position, assuming that that's it. It doesn't work. And then after sort of reviewing his trades thereafter, some of those positions went on to hit his target thereafter anyway. So what he's doing is he's expecting the market to go only in one direction and that's it, right? So the problem was more that he was not comfortable in risking that amount. So we went back to the drawing board and we defined an amount he was happy to risk, right? What would you be happy with to lose with each trade? That's the question you need to ask yourself, okay? Is it £5 or is it £50 or is it £500, right? How much can you lose on a single trade and it feel nothing to you? It feels like, okay, bad trade, move on. I'll review it later. That's what you should be doing. The minute you start to become emotional about that single trade is the minute is a step closer to your downfall, basically. Okay, so it's important you remember to allocate the right amount based on what you're used to. Okay, now when it comes to defining the stop loss, there are a few areas that you need to sort of predefine. Let's see if I sort of remove some of this. Come to sort of a blank view. Now this is what I tend to first look at. So to define the correct stop loss, just reviewing if there's any other questions. Okay, no. To define the stop loss, the first thing I will look at is to determine the distance. What's the average distance that I'm looking for when the distance from my entry point, so distance from my entry point to my stop loss, okay? What's the sort of, what's been the average, okay? So you need to determine the distance from your entry point to your stop loss. Now, I'll tell you why this is important. This was not important to me a while ago, but now it's become actually quite important because if I'm allocating a certain lot size to my trades and I have a maximum exposure limitation there, now if I have a 50 pip stop loss or a 15 pip stop loss, the amount of lot size I can get in will vary drastically, right? So I want to maintain a certain level of distance from my entry to my stop loss where it allows me to make the same return for the same amount of move that takes place. And I don't want, where I'm taking a, 3 lots position on one sort of trade and taking only a 0.3 lots because I've got a 100 pip stop loss, right? So I'm looking for much larger movement to take place, right? And that's when you sort of view whether you're a day trader, swing trader, and according to that profile, whether you're a day trader, swing trader, as a day trader, your stop loss should be somewhere between 5 to say 30 pips, no more than that in my opinion. If you're a swing trader, your stop loss should be 30 to 60 pips. Right? Maybe you look at the daily trading range, the DTR, and the way you look at the DTR is you look at maybe somewhere where you can define what is the average pip movement of that asset that you're viewing over the last 2 to 3 weeks and take a certain percentage of that to define how wide your stop loss should be. Okay, so the distance to your entry point and your stop loss is an important factor, and that's where you start to look at the DTR. Okay, the daily trading range. Okay, you need to monitor the daily trading range according to your trading style. That's an important factor. Okay, now there are a few more areas as well. It's not as easy as that. The next step would be is you need a technical reason. Right, you need a technical reason. That's where your TA comes into place, right? Your technical analysis, right? You know, it's pointless me defining, okay, I'm looking to go long now. I've got a downtrend over here. Price is broken through over here. I'm just going to get in. I'm not going to get in on the break of my TA reason, which is break of the previous high over here. I'm just going to get in now, just for the sake of it. That's not the correct approach. Your technicals, the whole point is, do remember, right? You carry out a detailed sort of morning process. You take part of these video tutorials and these webinars, right? You do a lot of analysis on your charts. You do all of that work to look for that trading opportunity. But as soon as you're about to take the trade, you just take it for the sake of it, right? Or once you're in the trade, a single candle puts you off the entire idea. That shouldn't be the case, right? Put in relevance to the amount of analysis you do. And it should be done in each part, not just your setup. Way too many traders focus on just setup. It should be your setup, your trigger, your execution, and your management of your process. Okay, so remember, that's where TA matters, right? I'm only going to take this trade if price breaks through this previous high, then I'm looking to go long, for example. Okay, so that's the other part of it. Now there's two other areas. Now it's the ongoing reward to risk ratio, right? So I call it the ongoing reward to risk ratio, right? Let me see if I can sort of get this going. Ongoing reward to risk ratio. Now everyone knows about reward to risk ratio on the outset. Okay, you know. Okay, let's now sort of define this, right? So I'm looking to sort of enter here. I'm targeting all the way up there, right? So I'm targeting somewhere about there. That's my TP, and my stop loss is over here. Okay, let's just go with a very simple sort of, you know, overview there. Okay, that gives me sort of a 1-to-1 reward to risk ratio. Let's just assume that. Okay, so from there to there, it's 1-to-1 reward to risk ratio. Okay, got a 1-to-1 reward to risk ratio in this trade, and then I take this trade, and I've totally forgot about the reward to risk ratio. Right, price could sort of trend higher, go in my favor, and it's there now. It's there, right? Price is there now. And I don't even check the reward to risk ratio. You should always check the reward to risk ratio. Now, price is here. From this point to my target, let's just define that as 1. From this point to my stop loss is now 3. So it's 3-to-1 against me at this point over here. Therefore, my ongoing reward to risk analysis is determining that I should look to trail my stop loss. Okay, and then you follow that same process. Then you look at the technical reason to move my stop loss. So my stop loss from here goes to, say, somewhere there. Okay, so I'll have a better reward to risk ratio. Right, I'll move my stop loss to the previous low. I look at the distance from my sort of entry to stop loss and so on. Okay, am I maintaining that same distance as I expect as an in-day sort of day trader? Right, is it maintaining 30 pips, for example? Right, so those are sort of the factors you look at. And the final, most important part is volatility. Right, you need to put a lot of weight on volatility. It's important you put a lot of weight on volatility. Okay, now how do we determine volatility? There are a number of indicators out there that you can apply volatility, defines the volatility. Right, we looked at the VIX index. That might be sort of the first thing you do in your morning process. Let me look at the VIX. Is the VIX, has it got greater volatility than the previous day? Right, add a moving average to it sort of to help determine that answer. Right, so you need to, now when you have an increase in volatility, that may determine that you need a wider sort of distance defined to your sort of DTR level, your sort of from your entry to your stop loss distance, right? Okay, so you need a wider distance, right, to just in case there's a large fluctuation that takes place. You see, last thing you would do is get stopped out on a spike. That's the last thing you would ever want, right? Large sort of stop loss hits, it completely reverses, goes against you, goes in your favor initially, what you initially expected, right? So your distance from your entry to your stop loss should widen if there's larger volatility. right? But also now you need to focus on the other two areas, right? I need a stronger technical reason. I need a much stronger, more confidence to my technical reason to take that entry, right? Because when there's greater volatility, it can go either direction, right? A lot new information can step in and it can reverse instantly, right? I've got to be sure that my setup is a very good setup, right? So increase the confidence you require to your sort of technical analysis. But also, you've got to make sure as you're getting a wider stop loss, right? The distance from your entry to your stop loss is wider. Your take profit has to match your expected reward to risk ratio. And that's where you might look for a better reward to risk ratio in this, right? Now, if you follow this process, there you go. That just generally is determining that you're probably going to take less setups. You're probably going to be taking less trades because of this now, because of the volatility, right? And that's where, as I stated right at the beginning, sitting in your hands is taking a position, right? There's a lot more I can go into it, but I am sort of running out of time as well. Hopefully that explains quite a bit. Now, just to sort of finalize on this, the indicators that could help you determine stop loss distance, but also in trade, sort of in trade stop loss management, sort of trading stop losses, is, as mentioned sort of in the chat over there, is ATR. ATR is a great indicator. Average true range. When you add this, it's an oscillator below your price. It tells you to the pips of the current volatility, right? I would say is when you add the ATR, it's set to 14 periods. Maybe you want to increase or decrease that based on the type of trader you are, whether you're a swing trader or day trader. Okay, how much information you want to take into this, right? The ATR is a good one, right? But don't forget the other indicators. Exponential moving averages can be great in defining where your stop loss should be. One of the best indicators I like is the parabolic SAR, right? Parabolic SAR, it actually sort of stands for stop and reverse. Stop and reverse, that's what it stands for, right? So it can help you determine where to place your stop loss. Or it could be a combination of 2 or 3, okay? So those are the 3 indicators I would sort of definitely encourage you to understand, research, and apply. Okay, and that's it from me, guys. That's it from me. I hope you've enjoyed this webinar, guys. Let me just answer some of these questions. What do you think about using ATR to help determine? Let me just come off this. There's quite a few questions. I've got to scroll up. Just move that out of the way. Go to a pen. Okay. Right, so yes, it's absolutely makes sense. Okay, what do you think about using ATR to help determine size of stop loss? Matisse, I would say not just the ATR. It's the entire process that I've gone through here, which is the most crucial. Okay, so it's the entire process. Remember, everything's about process, right? How do you just tell the difference between a professional trader and a retail trader? It will always come down to his process, right? It's never the technical ability, the fundamental knowledge, none of that stuff, right? What makes a professional trader compared to a retail trader is the process, okay? Okay, can the stop loss be placed just over PTL? Deji, if you want to just highlight what that means, what do you mean by PTL? What do you mean by PTL? Do you mean your profit level? Do you mean can your take profit be above your profit? Sorry, can your take profit level be above resistance? Is that what you're defining? Okay, something to sort of just mention, just what I always say. Your stop loss is always away from a level, so away from your resistance, away from your support level. Your targets are always set within your levels of resistance or support. Yep, so stop loss away, targets within. Okay, and that's to be covered on another webinar. So I'll cover that on another webinar, going into how do you determine the correct stop loss and the correct sort of take profit based on technicals. Okay, and that's it from me, guys. Thank you for joining, and I will see you on the next webinar. Okay, take care, guys. Bye-bye.